What's up? This is Ryan with Planet Cheapskate. In this video, we are going to tell you everything you need to know about seller credit. What is seller credit? How can it be utilized in your real estate transaction? What are the pros and cons of seller credit? Everything you need to know about seller credit, we are going to cover. Before we get to that, I just want to take a moment to invite you to subscribe to Planet Cheapskate, join our community. We are a community that shares information when it comes to real estate, home loans, living a frugal life, everything you need to know about those subjects. And when you do subscribe, be sure to hit that little bell and it'll alert you whenever we release fresh content. Now with all that out of the way, let's dive right in. So seller credit, what is it? Seller credit is a way of basically requesting that the seller gives you money to offset your closing costs. Now this could be to do a permanent buy down of your rate, so basically paying for points. This could be to offset your escrow fees, your title fees, anything when it comes to closing costs. Now, seller credit cannot be used to cover your down payment. You have to come to the table with your down payment, or you can receive gift funds from a family member, or you can get a down payment assistance program that covers your down payment. Seller credit cannot be used to pay for your down payment. Now, what are some unique things you can do with seller credit? Well, so say there's a home for sale that is $200,000 and your closing cost comes to $10,000, but guess what? You only have $5,000. So what you could actually do is you could increase your offer price for that home to $205,000 and then request $5,000 back in seller credit. Now, depending on what the market's like, if it's a buyer's market, if it's a seller's market, we've been in a long-term trend of a seller's market. Someday when you're watching this, it may flip and it could be a buyer's market, and you may be able to request seller credit without upping your offer at all, just asking for them to offset your closing cost. A typical market, sometimes you can just get them to split your closing costs with you. So whatever your closing cost comes to, it's just split in half between you and the seller. But there is a way that you can structure it where you can up your offer and then you can request that back in seller credit. And what you're basically just doing is you're transferring your closing costs and you're funding your closing costs. So you're not allowed to fund your closing costs directly, but what you are allowed to do is request seller credit from the seller to come out of their proceeds to fund your closing cost. And so it's a roundabout way of getting your closing costs covered. Whether you up your offer or not, that's basically what's going on there. So one of the big pros of seller credit is that it can reduce your closing costs. Now, you're still going to have the down payment because there is a down payment and a difference between down payment and closing cost. But what this does is reduce your closing costs. If you have a 0% down product, if you're a veteran, if you're doing a USDA, if you have a DPA, you can get your down payment to zero, and then say you're still going to have closing costs. So say your closing cost is still $6,000. Well, depending on the loan product, you could request that full $6,000. Now, something to be aware of with seller credit, each loan product has a different amount that you're allowed to ask for when it comes to seller credit. So for instance, FHA, usually for first-time home buyers, they know that you don't have a lot of money. And so what they do is that's the most lenient when it comes to the seller credit allowed, other than VA. VA is actually good, a different beast. We'll get into that too. But you can get up to 6% on an FHA. On VA, it's actually certain costs are unlimited. Like depending on the cost, you could get unlimited amount to offset it from the seller. But then there is some costs that are regulated to only 4%. You just need to check with your loan officer on what the difference is. Conventional is tapped out at 3%. You can't get any more than 3% to offset your closing cost. So that's the major loan products there that are covered, like the max that you can get. So the big con to doing seller credit is when you up your offer and then ask for seller credit back. You could actually up your offer too high to where your appraisal comes back and your home comes back not at value. So for instance, you find a house that's $200,000 and you ask for $5,000 back, and so it makes the offer price $205,000, and say the appraisal only comes back at $2,000. Well, guess what? The house did not appraise at value, so now it's $5,000 over. You may have to get rid of that seller credit and bring that money to the table, or you could have to find another deal if you can't negotiate some kind of a factor to it, because the lender is not going to lend you more than what the property is worth. So that's kind of a summary of all the things you need to be looked out for on seller credit. I'm going to make a series of these for different terms when it comes to real estate, so you're aware of those. I hope you enjoyed this video. If you did like this video, I'd like to invite you to watch one of my other videos. Over here, I walk you through every step of the loan process, and over here, YouTube has determined that you may enjoy this video. Please leave a comment below if you have any questions. Best of luck.